Alright everyone, welcome back. Now in today's episode we'll be taking a look at why I sold out of Lloyds banking group. We can see within my Trading 212 portfolio, and for those who are unaware, I use Trading 212 to buy and sell out of my dividend positions. So we can actually see that I sold out of Lloyds banking group, selling over 1,800 with a value of £1,000. The actual price per share was 52.75, and if we look at the current performance of the stock, we can see it settled around 53 pence per share at the time of recording. Now, one of the reasons why I sold out of this company was that the price was actually starting to creep up past that 50 pence mark. The next potential price that we see is around the 60 cent mark. But when I look at dividend-based companies, I don't focus on the actual price that the stock might reach based on past performances. I'm looking more at how solid the company is. In terms of the dividend yield, it was actually really solid at 3.97%. So you're probably still wondering, why did I sell out of this company? If I didn't focus on the actual price of the stock, given that's more of a growth-based strategy, and if I felt that the dividend yield was sensible, then what is the reason? So we can actually see within their balance sheet that the liabilities that they hold is too great, with a debt to asset ratio of 94%. Then if we look at their cash flow, they're actually negative, so they're financing, meaning that they're borrowing cash at minus £3.23 billion. They have an investing sector as well, but that's leaving a deficit of £2.54 billion, but their operating costs is at £6.62 billion. We can see that the weighting has been off in 2020. They closed their operating costs back in 2021, but still negative, and we're yet to see the reporting for 2022 in full. But if we look at the most recent quarter, which is that of Q2 2022, we can still see that this debt to asset ratio is only increasing at 94.4%, with their liabilities really pushing close to their assets. And the reality is that the price of the stock, when it does hit around 50-60 pence, in the past at least, there has been a pullback, but this is not a company that I'm looking to re-enter. If you're looking at the price difference, then there's much better growth-based stocks that can rise and fall, which allows you to enter and exit trades a lot quicker and maximize your return. But just the fundamentals of Lloyds has not been improving. It's been on my radar for the last couple of years, but I've held on. But with a sell price of 52.75, I was happy to exit the position. That left me with a profit of £386, excluding any dividends that I've earned over the last few years. And with that £1,000, I've actually allocated those funds into Persimmon. And you're probably thinking, well, that's an even more riskier scenario. But as I've covered in previous videos, we do have the potential benefit of the underlying stock increasing in value. That in turn should reduce this dividend yield, which is a weird thing to say in, because ideally you want to maximize the dividend yield, but 15.73% is dangerously high. Even if it was half this value, that would be the case. But assuming the stock price can push up, which I believe it can do so, that will reduce the dividend yield. But just looking at the fundamentals, with a profit margin of 28%, their debt to asset of 24%, the actual fundamentals of the company are looking very strong, and I do believe that the dividend yield can become a more sensible figure in the near future as the price of the stock improves. And we can see with the cash flow, the operating and any deductibles such as investing, financing, they average around this zero mark, which is a whole lot better than what I was seeing with Lloyds. Now, of course, Persimmon and Lloyds are two different entities, two different companies that operate in different sectors, so we're definitely not trying to compare like for like, but just wanted to call out that I've allocated the funds from Lloyds into Persimmon. In theory, the dividends should be increasing given the higher yield, but no doubt that value will come down in the future. Now, it's not very often I sell out of positions, especially in full, but we can still see that Persimmon is one of the highest weightings I have invested, over £6,000 into the company, but this figure is close to becoming in the green or profitable. If you're interested in this dividend portfolio, then I post updates on my channel. If you like this type of content, hit that thumbs up and share the video with any friends or family members. It really helps out the channel. New videos are posted each week, and with that said, I'll catch you in the next one.